Greetings everyone. In this video, we are going to look into some investing fundamentals. But before diving into the topic, let's look into something which is heart and soul of investing. Can you guess what it could be? Okay, without further delay, let's see what it is. If you want to invest your money, time and effort to achieve financial freedom, you should develop a habit of reading numbers and get thorough on some basic fundamental mathematical calculations. If you're not good at reading numbers, don't worry. There is a solution for every problem. If you can spend 10 minutes a day working on simple math like adding, multiplying, dividing, subtracting, and some problems related to percentages, with practice over a period of time, you will find it easy and interesting when analyzing a company's financial statement. Understanding numbers is the first step you need to take into account if you are planning to start investing. Just for fun, can you type in your answers for these math problems in the comments section below? I would appreciate it. Coming to the question, where do you invest your money? There are many ways to invest your money. Some of the familiar areas are you can invest in good businesses, which are also called as stocks. You can invest in real estate, such as residential properties, commercial properties, agricultural lands, residential lands, to name a few. Next is in CDs, bonds, mutual funds, such as index funds, which track S&P 500, precious metals such as gold, diamond, silver, platinum, and much more. Apart from this, there are several other places where you can invest your money, like crypto, NFTs, metaverse platforms, and much more. But before investing, you must do your own due diligence on how you are planning to invest, where you want to invest, how are you going to invest, and when you want to invest your money. You must understand the difference between investing and speculation. This will be a different topic further discussed in detail in future. For now, let's look into one of the basic fundamentals of investing terminology. What is a stock? A stock is an investment that represents a tiny ownership share in a business or a company. A company issues stocks in order to raise money to invest in their business, to grow or to expand. For investors, stocks are a way to grow their money and beat inflation over a period of time. This could be just one of the goals investing in stocks. Stock prices fluctuate throughout the day depending upon the sentiment in the market. One shouldn't expect that these stock prices will go up and up forever. You will experience volatility in the stock market on a regular basis. But if the company has a good business model, good management, and has consistent increased cash flow, low debt, and various other positive factors, there is an opportunity that the price of the company's stock will increase in value over a period of time. But on the other side, if the company has a bad business model, bad management, there is a chance that these companies will go out of business and retail investors may lose all of their investments or a part of their investment. That's why it's very important for an investor to do their own due diligence before investing in any company. Also, it is a good idea to diversify the investments in several companies rather than focusing on just one company. Please note that too much diversification is not a good investment strategy. Apple as an example here. Apple went public and released its shares to the investors. When Apple made good profits, a part of the profits were distributed to the investors as well in the form of dividends. So when you invest in a good company such as Apple, and if the company made profits, you as an investor gets benefited as well. Bonds are also called as debt securities, means that you are giving loan to a company or government. There is no equity involved here nor any shares to buy. Simply to say, a company or a government is debt to you when you buy a bond. Compare less risk, but they are not completely risk free. If you purchased a corporate bond and for some reason, if the company goes out of business and filed bankruptcy, you will stop receiving interest payments and there is a chance that you may even not get back your full principal. When you purchase a bond, you usually know what you're getting into. The duration of the bonds depends on the type of the bond you buy, but commonly they range from a few days to several years. And there are different types of bonds. First one is treasury bond or notes. And these bonds pays interest every 6 months until maturity. Second one is called as treasury bills. These bonds pay interest only upon maturity. Third one is corporate bonds. These bonds will pay interest either monthly, quarterly, semi-annually, or upon maturity. So when you're planning to invest in bonds, you should make sure the advantages and disadvantages associated with these bonds. Real estate investing is an investment portfolio where you can purchase residential properties, commercial properties, agricultural lands, and residential lands. When you invest in real estate, for example, when you purchase rental properties, you become a landlord. As a landlord, you will be responsible for many things like paying the mortgage, property taxes, and insurances, maintaining the property, finding tenants, dealing with any problems associated to the tenants or the property. So you need to consider if you will be comfortable in that role as a landlord. As a landlord, you can make money by collecting rents. How much rent you can charge depends upon the location of the property. For example, if the property is located in a safe neighborhood with easy access to public transportation, good schools, you can collect decent rents compared to other places where these facilities lack. It can be difficult to determine the best rent because if you charge too much rent, you will lose your tenants. If you charge too little rent, you will lose money from your pocket. A common strategy is to charge enough rent to cover the expenses until the mortgage has been paid off, at which time the majority of the rent becomes profit. The other way landlords make money is through property appreciation. If your property appreciates or in value over a period of time, you may be able to sell it at a profit or borrow a loan against the equity of the property to make your next investment, such as down payment for your next rental property. Real estate does tend to appreciate over a period of time depending upon the inflation and other various factors such as employment opportunities, jobs, and more. But there are no guarantees in this. A mutual fund is a type of investment portfolio where you put stocks, bonds, and other securities in one basket. Mutual funds gives an opportunity to small or retail investors to diversified portfolios at a cost. That cost could be sometimes high and sometimes it is low, depending upon the type of mutual funds you choose. Most of the mutual funds are managed by professional money managers and they charge hefty annual fees, also called as expense ratio, in order to maintain these funds. There are advantages and disadvantages investing in mutual funds. I would be very careful investing in professionally managed mutual funds as the costs are very high and there are several other negative factors. We can discuss all these details in a future video. You can also invest in precious metals such as gold, silver, diamonds, platinum, and much more. Sometimes investing in precious metals act as a hedge against inflation. Even in precious metals investing, there is volatility, and one should do their own due diligence before considering to invest in these precious metals. Where do you trade your stocks? Stocks can be bought or sold in a stock market, and the stock market is made up of several exchanges called as stock exchanges. Popular exchanges in US are New York Stock Exchange, NASDAQ, and there are also some over-the-counter stock exchanges where you can buy the stocks of a company that are not listed on NYSE or NASDAQ. Investors can then buy or sell these shares through stockbrokers, and some of the well-known stockbrokers are Vanguard, Fidelity, Charles Schwab, Robinhood, and much more. These stock exchanges track the supply and demand of each company's stock. How do you make money in stocks? For example, you have bought several companies' shares. You have done your due diligence and you think that these stock prices will go up in future, and you bought them at a right time. And over a period of time, the stock prices went up, and you plan to sell these stocks at that time. You have to sell only when the stock prices goes up, and when the selling price is greater than your purchase price, you make a profit at that time. This is also called as capital appreciation, and this is the way you make profits by selling stocks in the stock market. The other side of it is when you sell a stock when the market is in red, or when the market is in a bad condition, or when the company is going bankrupt, you make a loss. You don't want to sell a stock when there is volatility in the market. You have to make sure that you stick to that company long term if the company's fundamentals are looking good. I hope this video provided you an insight on various types of investments and a little bit overview on stock market and stock exchanges. I will come up with more information to share with you in near future, and until then, have a great day. Please like and subscribe to my channel, and don't forget to click on the bell icon to get new video updates.